What's up everybody, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending and investing. And today, we're continuing the journey down the world of ETFs, but specifically, it's ETFs versus picking stocks on your own. So you might be interested in investing, maybe even dabble a little bit with stocks and maybe even picking some unit trusts. But now you're at a stage in life where you might be earning a little bit more and you want to take investing seriously. You're looking at, oh my god, Tesla's really exciting. Or, oh my god, did you see that what happened with Kodak? Oh my god, did you see the glove stocks in Top Glove? So the FOMO is real. But you're not the person that makes silly moves, so you've calmed yourself down and you said, look, let's take things seriously. And now I've got to decide, do I start to maybe buy ETFs or do I really want to start my entire journey of picking stocks on my own? That's why I'm here to compare them both across a few key aspects, and then leave you with a few thoughts about a game plan on how you can use either of those two things. So let's start with a super simplified overview of the stock picking strategies that are out there. They broadly come in three big flavors, and the first is value investing. And value investing is simply about picking stocks that you believe are underpriced by the market. The next is growth investing, and like the name says, it's where you believe the company has strong prospects of growth and you're hoping that at some future point it's going to grow so fast and so much that you're going to profit from it. The final popular investing strategy is dividend investing. And dividend investing is really all about picking stocks that pay what we call dividends, which is basically money that the company gives out to you as a reward to its shareholders. And the truth is, those are just three of the really popular ones. And underneath it, there are way more nuances, way more variations that you need to think about. When it comes to ETFs, I've created a guide before so you can check that out. But generally, you have the same strategic choices that you would have if you wanted to choose an ETF. Your options might be a little bit limited in Singapore and Malaysia, but should you be interested in those type of strategies in the US markets, you'd have a lot of choice. So, decisions. So it's a lot to think about, and how do you do it? So I've got three different aspects to kind of compare them both by, so let's get into that. Let's start with a really easy one, which is what is your available cash at this point in time? So I'll start by assuming that you have less than $10,000 to start your investing journey, and in Malaysia and Singapore, when you buy stocks, you have to buy them in lots. So what that simply means is a single lot in Singapore and Malaysia is equal to 100 shares. So if you buy a stock that you like, by minimum you need to buy 100 of those shares at a single purchase. And that's going to affect your ability to diversify. The concept of diversification is kind of easy to understand. All you're saying is, look, don't put all your eggs in one basket. So if you were to build a portfolio, you would need to have a lot of different eggs, sometimes from 10 upwards to 30, for people to consider that as properly diversified. So with $10,000, it might be very difficult to diversify, but if you are starting out, that might not be a huge problem to think about, especially if you're very young. Just keep in mind that over time, eventually you will need a fair amount of money to adequately diversify into the different stocks that you want to own. And on the other hand, ETFs already are diversified because they tend to be a fund of many different stocks, but it also allows you to make purchases into other asset classes very easily. Next is your time and your interest level. So if you're new to stock picking, here's the kind of effort that you would likely need to think about as you move forward. It starts with choosing and then learning about the strategy that you're particularly interested in. And that's really just the tip of the iceberg. Because like I said, there's the variations underneath it, and there's so many different ways that you can pull off the strategy. Once you've done that, you've got to put together a holistic system on your own on when do you buy, when do you sell, by how much. And then begins your journey of gradually building your portfolio. Again, it's about 10 to 30 that you're eventually working your way up towards, but each of these analyses take a lot of time for you to make those type of decisions. But once you build that portfolio, things get a bit easier after that. So you'll need to spend time maintaining that portfolio, again just keeping track of different companies you've bought, but eventually you need to spend time to analyze new opportunities and swap out some of the older ones because they might not be performing as how you imagine them to be. With ETFs, however, because there are already baskets of them, your involvement tends to be a little bit lower. You still need to look a little bit into analyzing different type of ETFs, their expense ratios, the different type of holdings they have, and maybe even the fund manager if you're looking towards actively managed ETFs. But the best part is, once you've done that, usually the maintenance tends to be very low. For me, for example, I barely touch my portfolio of ETFs. All I do is continuously buy and add to it. So there's also very little effort involved in pleasing the gods of YouTube by clicking on that like and subscribe button. So this brings us to the final big aspect, which is your ability. So if you are more oriented towards passive investing, you are basically trusting that the broad market over time is going to reward you. But you're going to forgo the rocket ship returns that a lot of people are really chasing for. This style of investing doesn't lean on any form of stock picking skills. And even should you be choosing specific strategies instead of just broad market indexes, remember that ETFs are baskets of stocks. And in the basket, should one egg fall out and it breaks, it's okay because you've got the rest of the eggs in the basket. For stock pickers, you really don't have to look far to see many promises on how some people have really cool formulas that's going to help you beat the markets. Unfortunately, things are honestly stacked against us as retail investors, and a lot of them are actually psychological in nature. Let me walk you through a few of them. The first one, which is what we're seeing right now in this market, is called availability heuristic. Now, don't be afraid of that fancy term. It simply means our decisions, including investing ones, tend to be made because of what we can remember. Which is why in this environment, it's so interesting because lots of people are talking about stocks. You're looking at headlines. You've got that friend that say, look, I just made a ton of money after the March crash. I bought Facebook shares and I'm now just rich. Or I bought Tesla when it was 200 and now it's about 1,004. So it's really amazing, and then we feel like we can do it too. And as an effect, the universe of stocks we look into becomes very narrow as opposed to the wider scope that we should be looking into and analyzing. The other factor is overconfidence. Remember that friend that bought Facebook? He's not that smart, right? You could do better. Or maybe you've seen successful people with proven systems and you feel that, hey, yeah, all I need to do is sign up for this course and I can pull off the exact same formulas and I'm going to be as rich and as successful as them. But I just want to remind you that despite the fall in stock markets in March, ever since 2009, we've seen one of the greatest bull runs in this market. So, because a rising tide lifts all boats, you have to ask yourself, is that person a genius, or is that person just lucky and rode the entire wave of the bull market? The ability to become a good stock picker and analyzer is truly an art form. Some people can do it, but I certainly couldn't despite trying for many years. So all I did at that point in time was consume information which reinforced my idea that I could do it. I didn't know of, or I didn't pay any attention to the data out there that shows the exact opposite. And ignoring all that information is actually called confirmation bias, where we just look for information that supports our worldview rather than looking at data to the contrary. So those are just some examples of the different psychological issues that we have to battle as individual investors. And the more active you are as an investor, you're going to be subject to more of these type of psychological challenges that you need to overcome. So what's the game plan here? If I sounded like I'm pro ETFs for beginners, it's because I am. The best part is there are actually other variations that you can consider as you grow with more time, money, and interest in the markets. It really doesn't need to be a black and white situation. So this is variation number 1. You can start by picking index fund or funds that you like and then gradually add on different kind of asset classes. And once you've got that core portfolio ready, you can begin to add on individual stocks to skew your portfolio. So to give you a specific example, let's say you bought into SCHB, which is an ETF that holds the total stock market in the US, and then you really believe in Apple. Then you buy Apple shares specifically to add to your portfolio. So SCHB already includes Apple shares within its basket. But by buying additional Apple shares, what you're doing is you're betting extra on the company. The next variation is similar in you building a core ETF portfolio and then you're buying individual stocks to diversify or as a form of entertainment. So you could have your core portfolio in the US, maybe Singapore, and maybe Malaysia, but then you're really interested in Samsung. So Samsung is listed in Korea, so by buying it, yes, you're diversifying a little bit geographically, but maybe you're also kind of diversifying a little bit more into tech. The last variation is for those of you who decided to build your own stock portfolio anyway, and then you can use ETFs as a form of diversification. So for example, if you really like dividends and you build a dividend portfolio over time, what you can begin to do is diversify with an ETF of maybe growth stocks. You can use them to buy bonds, you can use it to diversify geographically. So there's a real wide opportunity of options for you to choose from. So as with all investing, things can be as simple as you want it to be or as complex. The choice is yours. So I hope you found this 3-part series in ETFs interesting and exciting for you. And if you did, I would really appreciate you hitting that like, subscribe, as well as that bell button, because I'm going to be back again next Sunday with a brand new video. And until then, take care and keep playing your own game.